Over the last 3 years, the US rental market did something most people didn't think could happen in a modern economy. It didn't rise gradually. It didn't trend up. It detonated. From Miami's waterfront towers to Seattle's tech corridors, landlords behaved like rent had become immune to reality. In many cities, monthly prices jumped by hundreds of dollars in a single renewal cycle, and owners assumed tenants would absorb it because what choice did they have? And for a while, that assumption looked correct. People cut back everywhere else. They stretched their budgets. They took on roommates. They drained savings. They accepted smaller spaces for bigger payments because the alternative was instability, moving, commuting farther, or losing the zip code that kept their job and lifestyle viable. But here's what always happens when a market gets drunk on momentum. It forgets there's a ceiling. And in 2025, that ceiling is finally showing up. The landlord leverage that defined the last cycle is weakening fast. In many of the same cities that led the surge, we're now seeing the opposite problem. Too many units, not enough qualified renters, and a population that has hit its financial breaking point. Vacancies are climbing. Concessions are back. The free month offers that disappeared during the boom are reappearing, quietly at first, then everywhere. And for the first time in more than a decade, renters are negotiating from a position of strength. This isn't a small correction. In several major metros, we're seeing year-over-year declines large enough to change behavior. When rent drops meaningfully, people move differently. They stop panic signing. They shop harder. They demand better terms. They leave bad deals. And landlords, the same ones who acted untouchable, start to sweat. Because when occupancy slips, cash flow collapses. And when cash flow collapses, debt gets loud. Developers overshot demand. Investors stretch themselves thin chasing returns. And the renters they counted on, the workforce that actually makes these cities function, simply can't keep financing the fantasy. You're watching US Market Breakdown, and today we're counting down the top 10 US cities where rent is crashing and landlords are sliding into full panic mode in 2025. Stay with me to number one, because the city at the top isn't just seeing discounts. It's showing signs of a deeper shift, one that could reshape renting in America for years. If you want more cinematic, data-driven deep dives into the trends changing where people live and why, subscribe now. Let's get into it. Number 10, Austin, Texas. Austin's rise was fast, loud, and almost mythological. A city that used to feel like a creative tech outpost suddenly got handed the crown, the next Silicon Valley. From 2020 through 2023, it was migration on steroids. Remote workers poured in. Startups relocated. Venture capital followed. And the city responded the way boom cities always respond, by building and pricing as if demand can only move in one direction. Cranes took over the skyline. Luxury towers multiplied. Every new building marketed the same dream: rooftop pools, co-working lounges, resort-style living, and a price tag that assumed the high-income wave would never end. But here's the part developers never like to admit. A city can build faster than a market can fill. By 2025, Austin is in the hangover phase. Average rent has fallen roughly 14% year over year in many pockets, one of the sharpest drops in the Sun Belt. And the visual evidence is everywhere. New units sitting open, amenities unused, leasing offices suddenly aggressive. The incentives tell you the truth before headlines do. 3 months free, deposits waived, price cuts disguised as limited time promotions, even random perks and gift cards showing up like a desperate handshake. So what changed? Austin didn't lose its identity overnight. It lost the fuel that inflated the top of its renter pool. The tech narrative cracked. Layoffs and hiring slowdowns hit the exact demographic that was supporting the highest rent tiers. When your premium units are priced for people making premium money, you can't replace those tenants with regular demand and expect the math to work. Downtown towers that once had wait lists now have vacancies that feel unfamiliar. And in a market built on confidence, unfamiliar is dangerous. Owners who borrowed aggressively during the frenzy are feeling it the hardest. Interest costs don't care about your hopes. They care about your occupancy. For renters, Austin is becoming the overdue turning point. A city that priced out its own working population is finally being forced to negotiate with reality. The message from Austin in 2025 is simple. The faster you climb, the harder you can fall. And the ripple from that fall is moving through the entire Sun Belt. Number 9, Miami, Florida. Miami didn't just experience a rent boom, it experienced a cultural illusion. During the surge, the city became the playground of remote professionals, high-end transplants, and speculative money. Crypto headlines, status migration, international investment. Miami wasn't renting apartments, it was selling an image. From 2020 to 2022, rent increases were brutal. In some areas, they felt violent. Prices jumped more than 60% in a short span, and longtime residents were squeezed out in real time. Luxury towers filled with people chasing the lifestyle, and owners acted like it would never slow down. By 2025, the shine is wearing off. Average rents are down roughly 11% in many areas, and vacancy rates are rising in the neighborhoods that were marketed as unstoppable. Brickell, downtown, Miami Beach. And once again, incentives are the honest signal. Free parking, zero move-in fees, gift cards, flashy offers designed to distract from the simple truth. Landlords need bodies in units, and they're not getting them easily. But Miami's correction isn't only demand-driven, it's expense-driven. Insurance premiums have surged. In some cases, they've tripled. HOA fees are climbing, especially as buildings face stricter safety realities and higher maintenance burdens. Special assessments are becoming a recurring nightmare. That combination, softening demand and exploding ownership costs, is a perfect recipe for panic. Investors who thought Miami was a permanent cash machine are discovering that paradise has carrying costs. Units that once traded near peak prices are sitting longer, listing lower, and bleeding owners monthly. Short-term rental operators are also feeling the squeeze. When tourism softens even slightly and your maintenance costs rise, the easy profit story collapses quickly. From the outside, Miami still looks like a postcard, but markets don't run on postcards. They run on numbers. And in 2025, Miami is teaching a harsh lesson. When luxury pricing outruns local reality long enough, the correction doesn't ask permission. Number 8, Atlanta, Georgia. Atlanta was sold as a safe bet. Job growth, affordability relative to coastal markets, steady inflow from both coasts. Atlanta looked like the responsible boom city. The place where growth wasn't just hype, but structure. Developers believe that story completely. Between 2021 and 2024, tens of thousands of new units came online across Midtown, Buckhead, and the suburban rings stretching outward. It wasn't cautious building, it was conviction building. By 2025, that conviction is cracking. Rents are down about 9% in many areas. vacancies are rising, and in a market that once prided itself on stability, landlords are being forced into the same behavior we're seeing everywhere else. Heavy concessions, aggressive lease offers, and a sudden willingness to negotiate. But Atlanta's issue isn't just oversupply, it's affordability pressure meeting real life. Wage growth has cooled, while living costs haven't. Inflation has chewed through household flexibility, and student loan payments returning to the equation pulled cash out of younger renters' budgets. So renters adapt the way people always adapt when rent becomes irrational. Roommates, moving home, leaving the metro, or choosing older housing stock. Even the suburbs that once felt insulated are being pulled in. Single-family rentals linger longer. Investors cut prices faster. Short-term rental owners try to convert to long-term leases and discover the demand isn't infinite. Atlanta isn't collapsing in one dramatic event. It's a slow squeeze. Too much luxury supply, not enough affordability, and a renter base that's no longer willing to stretch until it breaks. In 2025, Atlanta is proof that steady growth can still overbuild itself into trouble. Number 7, Las Vegas, Nevada. Las Vegas has always been a city of extremes. It thrives on risk. And right now, it's landlords and investors absorbing the downside of that risk. For years, Vegas looked unstoppable. Migration from California surged. Investors bought aggressively. Short-term rentals multiplied. And the assumption was simple. Demand will keep rising and someone will always pay. By 2025, momentum has thinned out. Since the peak, rents have fallen close to 10% in many areas, and vacancy rates have climbed sharply. Large communities in Henderson and Summerlin are seeing empty sections, something that wasn't supposed to happen in the new Vegas story. And beneath the neon glow, the fundamentals tell a quieter truth. Supply outran demand. Tourism still matters here more than people want to admit. If conventions shrink, if hiring slows, if tip income thins out, the renter base tightens, not dramatically, then all at once. At the same time, short-term rentals that once relied on weekend traffic are being pushed into the long-term market as owners try to cover costs. That floods the rental pool even more. So landlords cut, and investors who bought near the top realized that cash flow was a fragile story built on perfect conditions. The worst part? Projects approved during peak optimism keep finishing. More high-end units keep arriving in a market already saturated. In 2025, Las Vegas feels like deja vu. Not because the story is identical to 2008, but because the mistake rhymes. Speculation, overconfidence, and a belief that fundamentals don't matter because the city is special. Markets are never special forever. Number 6, Phoenix, Arizona. Phoenix was the furnace of the Sun Belt surge. Families moved in for space and sun. Transplants arrived for affordability. Developers responded with speed, building entire communities across Chandler, Mesa, Glendale, selling the promise of permanent growth. But by 2025, Phoenix is drowning in excess supply. In a short window, tens of thousands of units hit the market, and demand hasn't kept up. Average rent is down roughly 12% in many areas, and leasing offices are waving incentives like flags, free rent periods, furnished units, utilities covered, anything that reduces hesitation. But Phoenix's situation is also getting squeezed by ownership costs. Insurance, maintenance, and financing pressures are hitting at the same time rents decline, compressing margins fast. Investors who bought pandemic-era priced assets are now dealing with the most painful condition in real estate. being underwater while cash flow weakens. And Phoenix's job market isn't immune. Higher interest rates and slower corporate expansion reduce the influx of new workers. The same workers developers assumed would absorb the new housing wave. Phoenix in 2025 is a textbook correction. A market built for future demand that arrives slower than expected. When supply shows up early, the market punishes the overconfident first. Number 5. Dallas, Texas. Dallas spent years acting untouchable. Companies relocated. Young professionals moved in. Suburban expansion felt endless. Investors treated Dallas like an economic engine that couldn't stall. In 2025, the engine is sputtering. Rents in areas like Uptown, Plano, and Frisco are down around 10% in many pockets, and vacancies in high-end buildings are at their highest levels in roughly a decade. The reason is basic math. Too much new inventory collided with renters pulling back. Inflation narrowed budgets. Interest rates stayed elevated. People downsized. Roommates became normal again. And landlords, who once dictated terms, started offering concessions to stop the bleed. The deeper issue is imbalance. Dallas built a lot of luxury, but renters need livability. Even strong corporate presence can't save a market if the pricing outruns the renter base. Hiring slowdowns in tech and finance matter here because those sectors feed the premium rental tier. When that tier weakens, the dominoes fall. Dallas still looks impressive from a distance, but in 2025, it's learning a lesson every boom market eventually learns. Scale doesn't guarantee immunity. Number 4, Boise, Idaho. Boise was the pandemic-era breakout story. A smaller city suddenly treated like a national solution. Space, scenery, safety, and a slower pace. Remote workers arrived with higher incomes and cash offers, and the market inflated rapidly. Developers built as if the migration would never end. By 2025, the illusion is fading. Rents are down roughly 13% year over year in many areas. Vacancy is rising faster than much of the Mountain West. And downtown units that once leased instantly are sitting longer, sometimes for months. Boise's problem is brutally simple. The pricing was built for incomes the city doesn't naturally produce. Teachers, nurses, and service workers can't support Silicon Valley level rents. The boom relied on an external population. When that population slows or leaves, the market is exposed. The suburbs feel it too. Meridian, Nampa, Eagle. Projects pause. Investors sell. Local businesses that thrived on newcomer traffic tighten or close. Landlords cut prices aggressively, but the deeper correction is structural. Housing was priced for a version of Boise that existed briefly, not for the Boise that lasts. In 2025, Boise is a warning about hype migration. When the escape ends, the market returns to the realities it tried to outrun. Number 3, Seattle, Washington. Seattle's skyline used to signal confidence. Tech growth, dense development, non-stop construction. Seattle felt like the future. But in 2025, the tone has changed. Average rents are down around 10% in many areas. Vacancies are rising. And layoffs across the tech ecosystem have hit the renter base that supported premium pricing. Downtown buildings that once had wait lists now advertise incentives openly. Neighborhoods like Capitol Hill, South Lake Union, and Belltown are seeing discounts that would have been unthinkable during the peak. The suburbs aren't insulated either. Bellevue, Redmond, Kirkland, the same pattern spreads. Renewals decline, tenants move, and inventory piles up. But Seattle's shift is also psychological. The pandemic changed what people want. Prestige matters less than balance. Remote work changed the demand map, and a steady outward migration is draining pressure from the city core. Seattle still looks stunning in the mist, but in 2025, the market underneath that beauty is admitting something quietly. Even tech-driven growth has limits. Number 2, San Francisco, California. San Francisco is the clearest example of what a true rental collapse can look like. Rents are down roughly 15% year over year in many segments, and downtown vacancy has pushed into record territory. Towers that once demanded 4,000 plus now struggle to fill units at lower numbers, even with incentives stacked on top. The reason is structural. The exodus didn't reverse. Remote work didn't fade. It became normal. And the downtown ecosystem that relied on daily commuters, restaurants, retail, services, lost the foot traffic that made the city feel alive. But beyond economics, San Francisco is battling perception. Quality of life concerns have accelerated renter decisions. And once perception shifts, rent discounts can't fix the narrative quickly. Investors are stuck. Taxes, maintenance, and insurance pressure are high. And refinancing can lock in painful losses. Meanwhile, cultural spaces close, storefronts empty, and the city's identity feels thinner. San Francisco's correction isn't a temporary dip. It's a transformation, a reset of what the market can realistically support when the engine that powered it has changed permanently. Number 1, New York City. For decades, New York's rental market was treated like gravity didn't apply. Recession, demand returns. Crisis, demand returns. Shock, demand returns. In 2025, that myth is weakening. Average rents in Manhattan are down around 12% in many areas, with parts of Brooklyn and Queens seeing declines closer to 15%. And when New York starts offering concessions again, you know something has shifted. Free months are back, deposits waived, upgrades included, landlords competing again because occupancy matters more than pride. New York's issue is multi-layered. Job cuts in finance, tech, and media hit the renter base. International demand has softened amid global uncertainty, and the cost of living has pushed younger professionals to reconsider the entry fee. Cities like Philadelphia, Charlotte, Nashville, places that offer opportunity with less financial strain, have become real competitors. New York isn't collapsing in one dramatic moment. It's tightening gradually, but it's unmistakable. In 2025, even New Yorkers are saying it out loud. The empire of rent hit a ceiling. The skyline still shimmers. The culture is still electric. But the market underneath has changed, and renters can feel it. Across the country, this isn't just a pricing adjustment. It's a power shift. For the first time in more than a decade, renters are regaining leverage. Not because landlords suddenly got kinder, but because the market finally got honest. Developers built luxury, while renters needed livability. Investors chased returns, while households chased stability. And when a system runs on imbalance long enough, the correction doesn't arrive politely. Some cities will rebound, others may contract. But the lesson is universal. Housing markets don't outrun reality forever. You've been watching U.S. Market Breakdown, cinematic deep dives into the transformations reshaping America. If this breakdown sharpened how you see the rental market, subscribe, turn on notifications, and share this video. Because what's happening now isn't the end of the story. It's the beginning of the reset. And as always, when the noise gets loud, the numbers tell the truth.